Hi, I'm Dave Brinkman, partner in the Schneider Downs Wealth Management practice, and I'm here with my colleague, Jason Staley, our Chief Investment Officer. And today we're going to talk about a disciplined investment approach. So Jason, when we think about a disciplined investment approach, what's kind of the first step for an investor?
Well, I think that, a lot of people would try to just immediately dive into the investments, and I think that's where you would make a mistake. I think the most important piece of a disciplined investment approach is to analyze what your goals and objectives are. What are you working toward? And so really, before we even get started on the investments, you kind of have to marry your investment plan with an overall holistic kind of financial plan. So you get that big picture. And from there, you can do the fundamentals and the mechanics of asset allocation and portfolio construction to create that kind of disciplined investment approach. And there are some behavioral aspects that go along with it. But if you don't have a solid financial plan where you know exactly what you're working toward, all the portfolio construction and asset allocation won't mean anything if you don't know what you're working toward.
So Jason, let's assume that an investor has a kind of a holistic financial plan in place. What are kind of additional steps they should think about?
Well, I think that once you have what it is you want to achieve and you have an end goal in mind, I think then you sit down with an advisor and really work toward understanding how much risk you want to have in the portfolio, right? So what are you comfortable with? And I think that there's kind of two components to that. There is the amount of financial risk that you can take, right? Which is to say, how much money do you have and how much money can you put at risk? And then there's kind of the emotional risk. How can you tolerate, what is your risk tolerance when the market goes down? So at what point are you going to feel enough pain where you would be forced to change your investment outlook or your investment approach, right? The worst time to find out that you're not a 70% stock, 30% bond investor is, kind of March 8th of 2009 before the market bottoms and you get the biggest, rally in financial assets in history, or in March of 2020 when COVID fears had taken the market down 33%. You do not want to figure out that you cannot be a 70% stock investor, because if you change that outlook, you have locked in those losses, and it's going to take a long time, if ever, that you're going to be able to recoup them. So I think working with a financial advisor to, one, understand your financial risk tolerance, and two, your emotional risk tolerance, your kind of the behavioral aspects. You kind of marry those two with a financial plan, and now you have the recipe for success, in that what we as advisors want to do when we work with clients, you want to create a portfolio that a client can hold in the best of times and in the worst of times. So they're not chasing returns to the upside, but they're also not calling you feverishly trying to change their investment approach when the market's down. Because what we've seen, and a lot of academic research has put out there, that if you just stick with an investment plan, whether it's 70-30, 70% stocks, 30% bonds, 60% stocks or 40% bonds, you're going to end up in a better place if you just stay invested. And I think that's the critical component, is you understand what you're working toward, and then you get with an advisor and you talk about, well, what kind of risk tolerance, do you really have? And I think as advisors, we do have a lot of tools at our disposal to show them, not to say the past is prologue, but we can say this is what, generally speaking, a 70% stock, 30% portfolio did in March of 2020. Would you be able to look at your, Charles Schwab account statement and say, okay, that's not great, but I'm going to stick with this plan? Or are you kind of crying uncle saying, I can't take the pain anymore?
Because most of the time we're going to focus on the downside when talking through your risk, right? Versus maybe the upside that would be there for an investor.
Absolutely. And I think that there's always, as investors, we're humans, right? So there's going to be that condition that you're always going to want more when the market's trending upward. And I think as humans, one of the things that we have that's been well documented is that the pain associated with loss overwhelms any joy and excitement that you get from stock appreciation or doing well. And I think understanding that that kind of yin and yang associated with investing, I really do feel like if you can understand what your risk parameters are, kind of construct the portfolio and work with your advisor, that's going to lead to a much better outcome than kind of testing the winds and trying to figure out, what kind of investor you are based on the market conditions.
So Jason, maybe in closing, what level of dialogue should an investor be working with an advisor? What level of dialogue would you suggest they have on an ongoing basis?
I think consistent dialogue is important, whether that's through quarterly meetings or semi-annual meetings, then interspersed in between those kind of email communications. But I think as markets are not static, your investment journey is not going to be static either. And I think that's really important. We have different needs and goals and objectives when we're in our 30s, 40s, and 50s than we do when we're in our 60s, 70s, and 80s. And I think that kind of consistent dialogue, setting a cadence with your advisor and keeping that cadence, whether the market's up and you feel like you don't need to talk to your advisor, sit down, have the quarterly meeting, walk through your portfolio so that you're always able to answer kind of the three questions. I always say it's the kind of the napkin question, which is, do you know what you own, why you own it, and how it fits into your overall financial picture in terms of achieving your goals and objectives. Have those meetings and then be open and honest, create that kind of open and honest dialogue with your advisor so that they can understand as your goals and objectives change, you're not going to be a 70-30 investor your entire time. There's going to be a time where maybe you're a 60-40, where you've achieved what you wanted to, and now you want to have a little bit less risk. You want to protect that principal just a little bit more. It's just like markets are always changing, your investment risk tolerance is going to change as well. And I think that open and consistent dialogue is something that is inherently critical to this idea of kind of a disciplined investment approach, because even the best advisors they're not mind readers. And as we I hate to kind of continue to go back to the downside, but when you think about March of 2020, if you could have just held on for 2 or 3 more weeks, Congress passed a series of legislation, the Fed comes in and starts buying everything from high yield ETFs to every other kind of fixed income instrument you can imagine, and the markets start to recover. It just that dialogue, that consistent dialogue can be the difference between achieving your goals and objectives as you put forth in your financial plan, or having to work a couple extra more years, or maybe taking more risk than you feel comfortable with to try to make up what you lost in the market.
Well, Jason, thank you for your perspective and advice today.
No, I appreciate you inviting me on and taking the time to talk about disciplined investing.
Should you like to learn more about our investment approach or just in general how we work with clients, please reach out to us at sdwealthmanagement@schneiderdowns.com.